Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how's it going this week?
Feels like it's been a while. Oh, wow.
Yep.
It has been a little while. We took a week off, unintentionally so. I think we just kind of had a mix-up in communication, but we're back at it this week because you guys love to talk about the weather. It feels like fall is finally in the air.
Yep. Yeah, as I say, when you mentioned that, Derek, it reminded me of what's the Ferris Bueller's quote? Life comes at you fast, or if because sometimes life just comes at you fast, right?
Yeah.
If you blink, you might miss it. So yeah. Fall's in the air. Football's started. I was telling Derek before, John, that this weekend is the last weekend on the lake. We're one last hurrah, and then getting the pontoon picked up on Monday for its winter nap.
Hibernation. Yeah.
Yep.
Also, the Packers are probably going to win the Super Bowl. It's all looking good.
Well, the Vikings sure aren't at this rate.
Oh.
Yeah, I know. They look rough.
Wow.
We had such high hopes, and now it's
Yep.
like, okay.
Dashed.
Not
Packers
dashed.
look really
They
good.
can recover, but still. It's
I was in Austin, Texas last week, and it was probably like 95, and all the locals were like, "This is amazing! Like, don't y'all just love being outside at this point? Like, it's not 100% humidity and so I'm like, it is so nice to be in Minnesota in the summer. Like, it's so nice. Although recently I've been doing these runs in the morning, and it has been pretty hot. So like at the end of the run, have a million different gnats on me. Like it just looks like a war scene.
Yeah.
So that is kind of a trade-off recently running around the lakes, but
yeah.
Yeah, John, I go for walks in the mornings, and do you have to wear a hat? Like if you don't have a hat on, the Gnat podcast, you don't have a hat on, like the gnats just drive me crazy.
Yeah, no, hat, and like you got to keep your mouth closed because they sneak in your. It's so gross.
I know, super gross. Good topic.
Yeah.
Other gross thing.
That image.
Taxes.
Yeah. You know what? No, what else is gross? Taxes. And you know what helps to make them less gross? Whole life insurance, infinite banking. Yep.
That's right, folks. We are talking about the ways that an infinite banking or family banking policy is tax advantaged. So yes, it's a very common question or a very common thing actually for us to say is, hey, these accounts are tax advantaged, and our clients are going to initially ask, well, what do you mean by that? How is it tax advantaged? So that's what this episode is trying to get at here. First things first, right? When we're paying these premiums to the life insurance company, it's a very common question. Is this pre-tax dollars or after-tax dollars? Meaning, have I already paid income tax on these dollars going in to pay this premium? And simply put, it's all after-tax dollars. Or speaking in generalities, it's going to be after-tax dollars. There may be some unique circumstances to where we can structure and design policies with pre-tax dollars, but that's going to be very unique. So guys, talk to me a little bit about the tax deferred growth / the tax-free access. John, why don't you kick us off, and then we'll turn it over to Rob.
Yeah, so and just speaking to the first point, like I do get a lot of maybe more disappointed looks when it's clear that they're going to have to fund these policies with after-tax dollars. But at a certain point, it's like not the entire equation can be tax-free. Like if you're going to get so many tax benefits on the back end, the only cost is the tax on the front end, right? So these policies, with after-tax dollars produce many, many tax advantages on the back end that sustain for a lifetime, not necessarily just that one kind of after-tax premium dollar. And so another key component that we all know, taxes are a huge drag on growth, on compounding. I'm sure, I think we've talked about it in one of our old episodes. A penny doubled every day is the power of compound interest. Penny doubled every day within, like, I think it's day 28, reaches $1 million, right? Add a 30% tax every year on that. By day 28, it's like $17,000. It's ridiculous. So that level of drag that taxes has on growth is something obviously we are trying to avoid, and gives us the most certainty moving forward. Like, I can actually access all this growth, not having to guess what the taxes are going to be later on, not having to plan around, okay, well, if I do have to, experience this taxable event, create a bunch of different scenarios that's going to offset those taxes. Here, it's truly uninterrupted compounding, tax deferred technically, but the way we structure it is or the way we access it is tax free. And you get that right, that contractual right for the rest of the life of the policy. And so technically it's tax deferred, where if you were to just simply withdraw, right, just like from a savings account, you put your dollars in and then you withdraw the full amount plus the earnings, you would get taxed on just the gains, right? But we don't actually withdraw from our own cash value, right? We take policy loans against it using the power of leverage so that the full amount continues to grow at the uninterrupted compounding rate, and we access those dollars tax-free.
Yep. Yeah, and another one of the superpowers, that's one of the things we just love so much about infinite banking style whole life policies, is they just have so many benefits that people don't, aren't, the general public just isn't aware of. And that's why we do this podcast and inform our clients and prospective clients. But just so many little benefits to insurance policies that's just so helpful. Like the fact, like it's first in, first out versus last in, first out. And so you can take out your dollars, you can take out your cost basis if you want to. You have that option, and you're not getting taxed on it. And so it just gives you this freedom and these different levers to pull that you have with a properly designed, early cash value whole life insurance policy that you just don't get with other products. And it just gives you just more options to work with, and how it manages the impact of taxes and how you can access your capital. So just a great product.
Yeah, first in, first out, it's obviously we're talking about withdrawals. And John, you were just kind of saying, hey, we don't generally encourage it, but when it does make sense is probably when somebody's in their quote unquote retirement years or passive income years, and they are looking to take those dollars out of their life insurance policy, kind of to recoup their costs, if you think of it like that. That is an option. It's not necessarily going to be one that we would urge every client to do, but we do have that flexibility and freedom. What about this tax-free death benefit, John? Can you explain that for our listeners?
Yeah, I'm gonna start with a weird analogy or comparison. If I'm driving and I'm on the highway and someone hits me real bad, and it's a big accident, and I talk to my insurance company and they say, yep, your car's totaled, here's a check, we're not going to fix your car. That check that I get, right, is like the value of the car, that in their eyes, which is always way less, by the way. But you get this check, right? That check is going to be used most likely to purchase a replacement car, or in some cases, I suppose you could even try to repair your car. But you don't get taxed as like income for the check that you get to replace your car, right? The idea here is that the insurance company is replacing the value, or in technical terms is called indemnifying you, making whole something that was lost or something that is a gap. And that's exactly what life insurance is, just in a kind of different context, right? If I were to pass away right now, the gap to my family is significant as far as the income that I'm producing, and the future income that I will produce to provide and do things for my family. The life insurance company in that point will indemnify my wife tax-free income, just like I'm getting a check for my totaled car, um, with zero tax implications, right? And so that's the idea. The death benefit itself is, we always say, income tax-free. Like, no matter what, you will not be taxed as ordinary income for the life insurance proceeds that your beneficiary receives. The only way that your death benefit could potentially have a tax associated with it is if it's within your overall estate that exceeds the estate tax limitations or the gift exemptions. But that's in no way related to ordinary income, right? My father-in-law, his mom is on her last years, and he knows he's about to inherit a certain amount of dollars. Those dollars are just in a brokerage account, right? Just in investments. Those dollars, the dollars that have been funding it have been after tax. Anytime she accesses those dollars, it's taxable.
Yeah.
And when my father-in-law receives that inheritance, that's taxed as ordinary income. And then if there's estate, factors there. So it's like the government's getting all sorts of taxes along the way. And so here we're able to have that legacy piece without the drag of ordinary income. And then, if you're in the estate, threshold of 30 million for a couple, then there's different ways to even strategize to keep it outside of your estate and maintain the tax-free status.
Mm-hmm.
So that's a huge benefit. I mean, it's like ordinary income is likely going to increase in the taxes, in tax brackets. So if we're considering leaving a legacy in the next, hopefully very long time from now, it's likely that the ordinary income tax is going to increase, and that if we can shift the legacy piece into a bucket that's going to be transferred tax-free, what a significant savings, like for your
Huge.
beneficiary heirs, that the government's not going to get to have another, piece of the pie there.
And
Yep.
even if income tax rates don't increase or tax laws change, wouldn't you want to at least be planning for the worst case scenario? Like, let's do something to mitigate that risk of taxes increasing. We have no idea what the future holds, but it just makes a lot of common sense to me to just be like, okay, I don't want to play that game. I'm going to shelter my estate away from, get it out of the hands of the government if I can. What about Rob? How about you explain the tax-free dividends here for the listeners?
Yeah. It's another superpower of infinite banking, whole lifestyle insurance policy is the dividends. Dividends are not guaranteed, but the companies we work with have never not paid out a dividend over hundreds of years, and so they're not guaranteed, but historically they've been paid. So I plan on them when I'm looking at projecting out the growth of my policy. But that's another awesome factor of these policies is that the profitability of the insurance company, since we only recommend getting your policy through a mutually owned insurance carrier, which means you are a part owner of the company, any of the profitability of the company comes back to the company owners as a dividend. And that dividend is not taxed. That gets added to the ledger. It's credited to your ledger, and it's once it's credited, it's there, and it's part of your policy, and that growth is not taxed. And so, in one of our previous episodes, we compared the cash value growth of an early cash value whole life policy that we designed with a comparable high yield savings account, and you'll just see that the cash value growth of the insurance policy just far surpasses the growth of the high yield savings account because of these benefits of tax-free growth. And it's such a huge or tax deferred growth. It's such a huge advantage to having these policies in your family banking system because you can benefit from that tax-free growth and access that cash value as it's growing. So it's just another superpower, as I call it, with the infinite banking style policy.
Yeah, well said. Yeah. So, John, any comments about that tax-free dividend before we move on to the next one here?
It just kind of came to me as you were talking about it, Rob, is how incredible it is that you can leverage, you have your family bank, say you're in a mature stage of your infinite banking journey, and now you're providing banking services for
Hmm.
your generation. Say they get a mortgage through your family bank. Like traditional mortgages, you don't get a dividend for the loan that you just got out. You don't get earnings on, like, you don't get death benefit protection, all the
Yeah.
benefits that we're talking about. Like the dividend alone, like if it was just a dividend, can you imagine how many people would love their mortgage
Hmm.
if they got a
Yeah.
dividend from it? Like, uh,
Right.
by the way, like the banks probably could pay out a dividend to the borrowers. But that's not happening, obviously. The banks have all the control and all the profits and
Yep.
but if you're the family banker, if you're the owner of your own personal system, you get the dividends, you get the
Right.
profits, you get all the benefits. So it just kind of dawned on me just how incredible it is thinking it in the context of a mortgage. Like, what if we got dividends for the mortgages
Yeah.
we
Yeah. Right. Yeah.
I've actually been working on that in my head of like, could this be done? Could you get a traditional 30-year fixed rate mortgage and somehow the bank credits you some dividend or something like that to help pay down the loan faster? So I'd love to talk about that some other day, but right now it's just thoughts in Derek's head spinning. So let's talk
Hear
about
those.
some special cases here. The modified endowment contract is kind of the boogeyman in the life insurance space. Simply put, it's when a policy no longer maintains these tax advantages. And it's something that we will always, always, always avoid for our clients. You will
Hmm.
never see us designing a modified endowment contract for an organization, entity, individual, family who does not already have some tax advantages to mitigate that. So we've talked about in the past 501c3 nonprofits to where maybe a modified endowment contract can actually make sense in those cases. But for the
Hmm.
vast majority of our clients, excuse me, and the families that we serve, we will not be designing a modified endowment contract. Um, what about any other comments there on the modified endowment contract? Otherwise, we're going to move on to child policies.
I think we have other episodes on it already, so I don't want to, belabor that. But
Okay.
it's
Well, John,
very,
you're
very
the one that kind of came up with this idea of the, could we design a quote unquote tax deductible policy for children? So why don't you go ahead and explain that a little bit?
absolutely. So, most W-2 employees don't have this option and don't have a lot of options when it comes to tax mitigation, unfortunately. So, being a business owner, being able to take advantage of tax incentives and different things within the tax code gives you a lot of options. And one of them that I've been personally trying to implement and then also helping others with and seeing is, a big part of infinite banking is the generational wealth starting policies on young children so that you can have 75, 80 years of compounding and all the benefits. And generally, those dollars paid into those policies are after tax. But if you're a business owner and you have some way to employ your children, then you can pay your children a salary or income. And that income is not going to be taxed up to, I think, a certain limit. I think it's 15,250 right now. Don't quote me on that. I'm not a CPA. And I see this often where you can then deduct that from your top line, right? Have those dollars fund life insurance for the child. You can even do a mix of, life insurance. I see people do a mix with Roth IRAs, and we don't have to talk about Roth IRAs and anything like that right now. But those dollars then are actually pre-tax dollars that are funding life insurance. And you can do that as long as you employ your child and are a business owner and able to have a reasonable, employable task for your child to then pay them. Right? We're not talking about fraud. We're not talking about, tax evasion. We're just talking about tax strategy. And I think that's a really powerful thing. If you're already wanting to fund these policies anyway for your children, you can do so strategically and likely get some capital back into your pocket.
Yeah,
Nice.
I'm actually working with a client on that right now, and he's got some teenage children that are looking to join his business. And what I like about this, using the life insurance policy as opposed to the Roth IRA, is a Roth IRA can be great because it does teach the importance of saving and investing and allowing wealth to compound. But your child doesn't really get the benefit, the tangible benefit of being able to utilize the dollars to pay for that car that they're going to need when they hit 16, or if they choose to go into the workforce and or into the university system, something like that, right? They're going to need those dollars that they have been working for. And what a great way to teach them the process of a family bank. But if it's sitting in the Roth IRA, sorry, they really don't get that exposure to the family bank in the same way.
Right.
So
Yeah, what a great experience. I mean, isn't that just the beauty of it? That's why we love it so much, is you get to utilize the living benefits of your policy before a certain qualified age, right? There's no restrictions. You are the banker. The banker, the he who has the gold makes the rules, right? You have the banking system that you've created with your IBC policies. There's no restrictions on how you use those dollars. And what a great teaching tool for kids to show how they can be their own bankers and control their own dollars and take out their own loans and create their own payback schedules. And what a wonderful just educational opportunity.
let's jump to one of the last ones here, the no qualification status. And that's, Rob, I think you were just kind of mentioning this. There is no age like in a 401k or IRAs. There are no age restrictions or even age limits of when you can be paying a premium, how you can be accessing the cash value if it's either through withdrawal or through the policy loans. Whereas, let's just say the 401k, for example, right? You can't start taking dollars out of that 401k, largely speaking, until what? Like what, 59 and a half, I think is the cutoff right now.
Yep.
Or required minimum distributions. If you've got a large brokerage account, large individual retirement account, something like that, to where now the government is going to require you to take out a certain amount that you may or may not need or want, and you may actually want it to continue growing. Another one that I've seen, guys, recently is when somebody passes away and they're transferring an IRA to someone else. Now, even that has restrictions and limits, and it's going to require the family to basically withdraw all that dollars within, I think it's 10 years of transferring an IRA. So it's just another way that the government loves to get their hands in the cookie jar, and putting restrictions on your wealth. Whereas we don't have to monkey with any of that headache and stress.
Right.
We have that.
Right.
We have no qualification status there. We don't need the government to be telling us or asking, when can we take dollars out of these accounts? When can I utilize it? We've got all that freedom and flexibility.
Yep. We don't have to ask them if we can take out dollars, and we don't have to have any restrictions on when we're forced to pay it back. We don't have any limitations on how much we can take out. Yeah. Why would you not do it?
Andrew, Rob.
All right, guys, let's hit the last one here. The tax on the seed or the harvest. Rob, why don't you explain that for the listeners?
Well, we always love to bring it back to Nelson Nash and becoming your own banker. And that's one of the concepts he talks about is getting taxed on seed or harvest. That's one of the things we love about Nelson, how the lessons he's teaching us in that book, they're basically parables in a way. And this one, you think about a farmer, and when you are farming and you are going to be planting a crop, planting to grow a crop that you can then harvest. In order to get the crop started, you have to purchase seed, and that seed has a cost. And but that and he's saying, does that cost of the seed, would you rather be taxed on that cost of the seed, that those initial dollars for the seed, or would you want to get taxed on the exponential growth of the harvest of the crop? And obviously you'd rather get taxed on the seed. You don't want to pay the exponential tax on the harvest. And so I just think it's a really great word picture that Nelson has created in his book about there's wisdom in getting taxed on a little versus getting taxed on a lot. And that's the main point there is don't don't be afraid of using after-tax dollars, because you're just kicking the can down the road. You'll be getting exponentially taxed down the road when that harvest kicks in with your 401k. Why not take that a smaller amount now, plant it, get that same exponential growth, that same harvest, but then not be taxed on it because you have it in a tax advantaged product like whole life insurance.
100%.
Yeah, well said. John, turn it over to you for final comments here, and then we'll close out the episode.
Yeah, I think this is just icing on the cake to becoming your own banker, all the tax benefits, right? We have episodes where we've gone through the calculator of the factoring in the taxes, what you would have to earn in a different type of brokerage account or investment or even savings account to get something that's equal to this. Like,
huge.
Not having to worry about the taxes has an incredible impact on the usability of these policies and the flexibility and the control and all the benefits that we get. So if it was just the control that we have of the banking function in our lives, that would be good enough for me, honestly, just compared to especially compared to compared to the conventional banking system. But then on top of that, you get all these tax advantages. You get the tax-free death benefit, you get the tax-free growth and distributions and so forth. So it's a no-brainer, especially when factoring all of this. If you've ever paid more than a penny in tax, you likely don't like paying taxes. And so trying to find ways to create these tax advantages where you don't lose a single dollar or a single ounce of benefit is a no-brainer, right? I'll echo Rob's, like, why would you not do this? And just say it's icing on a very, very amazing cake.
Amen.
Well, guys, I've said it before, I'll say it again. The two biggest factors that will reduce your wealth long term: number one, taxes. Number two, interest to third-party banks. And by utilizing our own family banking system, we've just eliminated those two big problems right there to the greatest extent that we can. Right. So this, echo these guys. Why won't you do it? It's such an awesome feeling to know, like, hey, my wealth is not going to deteriorate because of those two factors. And my family is going to be much better off in the long run. So
sure.
Well said, guys. Well, thanks again for chiming in on the episode here and giving your comments. To our listeners, if you're interested in learning more about the family bank and want to get started, feel free to reach out to us, schedule time with one of us three, and we would be happy to assist you in your journey. Reach out to us at thefamilybankingshow@gmail.com, and we'll see you guys in the next episode.
Thanks.
See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.